Okay, we're going to continue with Chapter 11, COSO Framework, Committee on Sponsoring Organization. They're components of internal, and remember what internal control is according to the COSO process affected by those charged with governance, designed to provide reasonable assurance about achieving the entity's objectives with regard to the reliability of financial reporting, effectiveness and efficiency of operations, and compliance with applicable laws and regulations. So how do we achieve the objectives? Now, COSO said there's 5 components of internal control: the control environment, risk assessment, the client, how does the client assess risk and manage risk, actual control procedures or control activities, information and communication, and monitoring. Accounting is part of the information and communication system. Number 1, the control environment. The 2 things you want to read what the book says, but focus on the 2 biggies in my mind are management's integrity and the audit committee. If management of this is of the highest integrity and one of their goals is to produce reliable financial statements, you're probably not going to get in trouble. If management is trying to produce financial statements that don't fairly present, they can pull the wool over your eyes every time. Remember, nobody knows the company better than management. You go out there and audit them, they live it every day, 24/7. So don't think management can't bag you if they want to. The second thing we're going to talk about a little bit is the audit committee. Okay, for a public company, public companies are required to have a board of directors. They're required to have an audit committee. And for a public company, that audit committee must be comprised of outside directors who are not employees of the company. So the CEO is going to be on several of the committees, board committees. The CFO might be on a committee or 2, board committee. The chief legal officer might be on, but the audit committee has to be totally outside directors. The CEO can't be on the audit committee. The CFO can't be on the audit committee. And the audit committee is charged with appointing the auditors, resolving differences between the auditors and management, oversight of internal audit, and approval of non-audit services performed by the auditor. So if we want our auditor to prepare our taxes, that's a non-audit service by our auditor, and the audit committee has to approve that. If we want the same company, the accounting firm that does our audit, to perform consulting work for us, that's a non-audit service, and it must be approved by the audit committee. Second, risk assessment. Now remember, this is how the client manages risk. This is not us assessing their control risk, but how does the client manage risk? Remember what control is: reasonable assurance about achieving the entity's objectives. So anything that keeps the entity from achieving its objective is a risk. If the expected rate of return for an investment or a project exceeds the risk-free rate, then you've got to assume that investment activity is not risk-free. Business is all about managing risk. Otherwise, companies would just put their money in the bank and government-insured savings accounts. So companies invest in risky assets, risky projects. How do they manage those risks and turn their assets into cash receipts? Now, I like this. This is the little box on 350. Notice it's how does the company, so this is COSO not for the auditor, but this is COSO's enterprise risk management for companies. How do they manage risk? Notice there's similarity. The environment, risk assessment, control activities, information communication, monitoring. Those are all the same. But I really like this. So how does Miller Motor Company, we're going to audit Miller Motor Company. How do they manage risk? How do they set their objectives? If a control process is to provide reasonable assurance that an entity achieves its objectives, then what are their objectives? How do they set them? So Miller Motor Company wants to sell 100 cars a year. Then event identification. How do we determine, how does the company determine whether or not it's achieving its objectives? Is it on track to achieve its objectives? Then risk assessment. What is the risk? No, we're not achieving our objectives. Okay, 5 is what's the response? So I really like this. This is for the enterprise that we're auditing. This is for the audit client, not the auditor. But I think there's a lot of thinking that goes into that. Number 3, control activities. The book talks about adequate segregation of duties. That's boldface because we're going to talk about that. Authorization of transactions. Authorization. How are transactions initiated, authorized? Documents and records. How are they initiated, authorized, and recorded? That recording can be physical in the case of a document or computerized today. Physical controls over assets and records. Independent checks on performance. Now, we're only going to talk about 2, segregation of duty and adequate documents. But first of all, let me babble a little bit. Locks on doors are a physical control. The car dealership that I worked at in Tucson, when I worked there, they probably had 150 cars on the front of the fence, in front of the fence. Today, because of theft or problem, vandalism, they moved the fence forward. They probably only have 15 cars in front of the fence. That's a physical control. Fences, doors, walls. So think of the simplest things first. I was always intimidated by internal control. I could never get my hands around it. And I heard a panel of experts talking one time at a conference, and one of the people up there was John Willingham, who was a very important national partner for KPMG years and years ago. And everybody, these experts all talked about internal control. And finally, Mr. Willingham said, wait a minute. He says, I've done really well in this business, and I really struggle to understand internal controls. I go through the process. I do my best, but it's a hard thing to get your hands around. So that made it easier for me to accept the fact that I struggled understanding internal control. One thing he did say that left me was start simple and then add layers to it. So think about controls, think about locks on doors, thinking about having 2 signatures on your checks, thinking about getting things authorized. So think about simple things first. You can always design controls that are too complex to understand, so we'll save that for later. We want to talk about segregation of duties and documents. Now remember the accounting system, procedures by which transactions are initiated, authorized, recorded, processed, transferred to the general ledger and reported. That's the accounting process that we have to understand. Okay, so segregation of duties. Authorization of transactions has to be separate from the related asset. Right. So I can't authorize a transaction if I have custody of the asset. Somebody else has to authorize release of that asset. custody of assets from record keeping. If I both control the asset and the record keeping, then I can take the asset and adjust the accounting records so nobody knows it's gone. Record keeping from operational responsibility. They may have different goals and incentive. So the sales manager may have incentive to overstate sales. So we need to separate record keeping from operational responsibility. And finally, IT from everything. And the reason is so many of our controls now are embedded into the IT, into the programs, computer programs. That many times IT is an integral part of control for everything. So we just need to keep them separate. I don't know whether it's still done or not, but I know 100 years ago when I was auditing, you never let programmers program on a computer that had customer data. You always had them do the work on a computer without customer data so that they couldn't have access to customer data. Now, the 5-point answer was on the previous slide. I've got to separate custody of assets from authorization, custody of assets from accounting or record keeping, separate from the operating departments and IT from everything. So that's the 5-point answer. This is what I learned. It almost gets there. So we used to say we need to separate authorization of transactions from custody of assets from record keeping. That's probably a 3-point answer on the test. So the previous slide is the 5-point answer, but this is the 3-point answer. I justify it because that's what I learned. That's probably a poor justification. Segregation of duty, and we also want to talk about adequate documents and records. Pre-numbered documents, whether they're physical or pre-numbered in the computer, provide a powerful tool. So here's a case, a check that didn't get recorded. So here's my checks, 228, 29, 30, 31. When I look in the cash disbursements journal, what's missing? A check 2229 is missing. What is that? It's completeness. The cash disbursements journal is not complete and cash is overstated. How powerful are pre-numbered? Years ago I handed out the Vouch and Trace project to a student one day, and we went over it for 5 minutes in class. And at the end of the class, a young lady walked up to me and she says, sales are overstated. And I says, how can you possibly know that? And she says, I don't know how much are overstated, but they're overstated. And I says, how do you know that? And she says, well, because there's 45 transactions in the sales journal, and there's only 41 shipping documents or something like that. So pre-numbered documents allow us to find things like that very easily. So they're a powerful tool. Information and communication. The accounting system is a big part of that. So we're going to use the account balances to prepare financial statements for our communication with the outside world. Management 215, management accounting provides internal reports that are part of management's feedback for monitoring operations. So accounting plays a role in both external and internal communication. Monitoring, internal audit, compare reports with your knowledge of the business. So right now, what would you expect to be happening to sales if you're auditing a retail store, a restaurant? Complaints from customers and vendors. What are their complaints? Do the complaints provide information about the operation? company slow to pay their suppliers and vendors? Does that mean they have a cash problem? Periodic reconciliations. Do we reconcile the bank statement every month? Do they reconcile accounts receivable from the subsidiary ledger to the general ledger? Do they reconcile their physical inventory with their accounting records? Okay, so those are the 5 components of internal control. Tomorrow we're going to talk about a minimal understanding of the accounting system.